Two companies, same market cap, $43 billion. One of them spent $30 billion over the last decade buying back its own stock, retired 60% of its shares, shrank itself by 2/3. And after all that, it's still a $43 billion company. All that money, all that financial engineering, and they're standing in the exact same spot. The other one? It was a $1 billion dying software company 6 years ago, losing engineers to Salesforce and Microsoft. Nobody cared, nobody was watching, the stock was going nowhere. Then they made one decision: stop buying back your own stock. Start buying Bitcoin. Today, that company holds 843,000 Bitcoin worth $62 billion. And they invented a product that pays retirees 11.5% annual income. Tax-Deferred. Same market cap, $43 billion. Completely different universes. Welcome to Levels of Jackassery, Episode 2. This week, eBay versus strategy. Same destination, opposite journeys. Let's give credit where it's due. eBay is a legend. Founded in 1995 by Pierre Omidyar, one of the original internet companies. They pioneered online auctions, proved that strangers on the internet could trust each other with money, and launched an entire category of e-commerce. They gave birth to PayPal, literally spun it off in 2015. PayPal today is a $70 billion company. eBay created that and let it go. Revenue today, $10.3 billion. Trailing 12 months closer to $11.6 billion. Profitable, positive free cash flow. They process billions of dollars in gross merchandise volume every year across 130 million active buyers. Market cap $42.7 billion. PE ratio 25, 444 million shares outstanding. They even pay a dividend now. By the old playbook, this is a fine company. Not spectacular, not dying, just fine. But fine isn't the problem. What they did with $30 billion in shareholder capital is the problem. Since the PayPal spin-off in July 2015, eBay has been one of the most aggressive buyback machines on the Nasdaq. Shares outstanding in 2015, 1.22 billion. Today, 457 million. They've retired 763 million shares. That's 63% of the entire company. Gone, bought back, and canceled. In 2025 alone, they spent $2.5 billion on buybacks plus $531 million in cash dividends, $3 billion returned to shareholders in 1 year. Over the trailing 12 months, their buyback yield is 6%. They're buying back 6% of the company every single year. The estimated cumulative spend since 2015, $25 to $30 billion on buying their own stock. Think about that number. Their current market cap is $43 billion. They spent almost their entire market cap buying themselves back, and they're still worth $43 billion. It's like running on a treadmill for 11 years and wondering why the scenery hasn't changed. Let's do the payback math. Same framework from episode 1. eBay trades at 25 times trailing earnings. When you buy a stock at 25 times earnings, you are paying 25 years of profits for one share. That's the payback period. Good real estate, 9 years, 11% cap rate. Private equity acquisition, 8 to 12 times EBITDA. Money back in under a decade. T-bills in 2026, 4 to 5% risk-free. Immediate return. No execution risk. eBay buying its own stock at 25 times, 25 years. 4% implied return, with a decade of declining relevance attached. Now, 4% is better than Motorola's 3.2% from episode 1. I'll give them that. But here's the thing. They're paying 4% for a business whose revenue has been essentially flat for 11 years. You're paying 25 years of earnings for a company that isn't growing. At least pay a premium for growth. eBay is paying a premium for stagnation. This is the chart that tells the whole story. 2015, the year they spun off PayPal, eBay's standalone revenue was $8.6 billion. 2024, 9 years later, $10.3 billion. That's a 2% compound annual growth rate. 2%. Barely above inflation. In the golden age of e-commerce, when Amazon went from $107 billion to $575 billion, when Shopify went from public to a $100 billion platform, when Temu came out of nowhere and started eating everyone's lunch, eBay grew at 2% a year. They went from the king of online commerce to the place your uncle sells used golf clubs. Amazon built fulfillment centers, Shopify built merchant tools, Temu weaponized price, eBay built a buyback machine. 763 million shares retired. Revenue barely moved. They shrank the denominator instead of growing the numerator. That's not a strategy. That's financial cosmetics. Jamie Iannone became CEO in 2020. Let's look at his scorecard. Total compensation in 2024, $20.35 million. That's $1 million salary, $16.3 million in stock awards, $2.9 million bonus, and the rest in perks. His ownership, 446,000 shares, about $39 million at today's price, roughly 0.09% of the company. And here's the kicker. He's selling. His holdings dropped from 547,000 shares to 446,000 since December 2024. 100,000 shares sold. While the company spent $2.5 billion buying shares back. Read that again. The company is spending billions buying its own stock, while the CEO is selling his. The buyback machine runs to support the stock price. The CEO sells into the support. Shareholders fund the liquidity for management's exit. Compare that to Saylor, $1 per year salary, 9.9% ownership, can't sell without destroying his own voting control. His fortune rises and falls with yours. Same market cap. One CEO is cashing out, the other is all in. And then, in May 2026, the ultimate indignity. GameStop. Yes, that GameStop, the meme stock video game retailer run by Ryan Cohen, made an unsolicited $56 billion takeover bid for eBay. eBay's board rejected it as, quote, neither credible nor attractive, end quote. Now, the bid probably was a publicity stunt. GameStop doesn't have the financing for a $56 billion deal. Fair enough. But think about what it means that GameStop even thought this was a plausible headline. A struggling brick-and-mortar retailer looked at eBay, once the king of e-commerce, and said, I think we can buy you. That's where the brand has fallen. That's the state of the moat. When meme stocks start circling, you've gone from predator to prey. $25 billion in buybacks couldn't prevent that headline. Financial engineering doesn't build moats. Products do. Strategy does. Vision does. Let's play the what-if game. What if eBay had simply taken their annual buyback capital, roughly $2 to $3 billion per year, and put it into Treasury bills? Not Bitcoin, not a hedge fund. The most boring, risk-free instrument on earth. Over 10 years of buybacks at an average rate of around 3 to 4%, that $25 to $30 billion would have compounded to roughly $33 billion today. A liquid, risk-free war chest. $33 billion in T-bills sitting in eBay's treasury. That's 80% of their current market cap. In cash, they could acquire anyone, invest in AI, build new products, hire the best engineers in the world, or just sit on it like Berkshire and wait for the perfect pitch. Instead, they have fewer shares and a stock that roughly tripled in 11 years, which is about what the S&P 500 did. You didn't need eBay for that. You could have bought an index fund and gone fishing. Now let's get spicy. What if eBay had listened to Saylor in August 2020? What if they'd allocated just 25% of their annual buyback spend to Bitcoin starting in 2021? 25% of their buybacks from 2021 to 2025 is roughly $3 billion deployed into Bitcoin. At the average BTC prices each year, 47,000 in 2021, 19,000 in 2022, 28,000 in 2023, 62,000 in 2024, 95,000 in 2025, they'd have accumulated around 45 to 50,000 Bitcoin. 50,000 BTC at today's price of about $73,000 per coin is $3.6 billion. A modest gain. But remember, that's only 25% of their buyback budget. They'd still have 75% for dividends and share repurchases. What about 50% into Bitcoin? 100,000 BTC, $7.3 billion, almost 20% of their entire market cap in a single liquid appreciating asset. And if they'd gone full strategy, all in since 2021, they'd be sitting on a Bitcoin treasury worth more than the company itself. Instead, they bought their own stock at 25 times earnings in a business growing at 2%. Same capital, wildly different potential. Now let me tell you the other side of this story, because this is where it gets real. In 2020, Strategy, then called MicroStrategy, was a $1 billion enterprise software company, legacy business intelligence. Their product competed with Tableau, Power BI, Looker, tools backed by Salesforce, Microsoft, and Google. They were losing, slowly, quietly. The kind of death that doesn't make headlines. Talented engineers leaving for bigger platforms. Revenue flat. Stock price going nowhere for 2 decades. Wall Street didn't care. Nobody was writing articles about MicroStrategy. $1 billion market cap. A rounding error in tech. Then in August 2020, Michael Saylor looked at his treasury, $500 million in cash, and asked one question: what's this cash going to be worth in 10 years if I just leave it sitting here? His answer? Less. A lot less. Inflation was coming. The money printer had gone berserk during COVID. Fiat cash was a melting ice cube. So he bought Bitcoin, all of it. Then he issued convertible notes to buy more, then preferred stock to buy more, then equity to buy more, and a $1 billion dying software company became a $43 billion Bitcoin treasury. Let's look at where Strategy stands today. 843,738 Bitcoin, worth approximately $62 billion. That's more than the market cap of the company itself, meaning the Bitcoin alone is worth more than what the stock market says the whole company is worth. They went from $500 million in fiat cash to $62 billion in Bitcoin in 6 years. That's not a return, that's a transformation. And here's the thing people miss. Strategy didn't do this with profits from a booming business. They did it with financial engineering, but pointed in the right direction. Convertible notes, at-the-market share offerings, and a product called STRC. Same tools Wall Street has used for decades. Convertible debt, preferred stock, equity issuance. The only difference is what they bought with the proceeds. eBay used financial engineering to buy its own stock. Strategy used financial engineering to buy Bitcoin. Same toolkit, opposite outcomes. And here's the part that most people don't talk about. Strategy didn't just build a Bitcoin treasury. They built a product. STRC, Strategy's Variable Rate Perpetual Stretch Preferred Stock. That's a mouthful, but here's what it actually is. An 11.5% annual dividend, paid monthly, $0.9583 per share, every single month, like clockwork. And here's the part that makes retirees' ears perk up. 100% of those dividends are treated as return of capital. That means they are tax-deferred, not taxed as ordinary income when you receive them. They reduce your cost basis instead. When you eventually sell, you pay long-term capital gains, which for most retirees and Gen Xers is either 0, 15, or 20%, way lower than ordinary income tax rates. That's product market fit. There are 65 million baby boomers in the US right now who need income. Millions of Gen Xers approaching retirement with not enough saved. They need yield. They need it now, and they need it tax efficient. CDs pay 4 to 5%, fully taxable. Treasury bonds, 4%, taxable at the federal level. Dividend stocks, 2 to 3%, and you wait a year for qualified treatment. 11.5%, monthly, tax deferred. Backed by a Bitcoin treasury that's appreciated over 300% in 6 years. Sure, there's risk. Bitcoin can drop 40%. The dividend rate adjusts monthly. You need to understand what you own. But once you do, you can allocate accordingly. And for a retiree who needs income today, 11.5% tax deferred is a product nobody else is offering. That's not financial engineering. That's a product. And the market for it is enormous. Let me bring this home, because Joe, the guy who runs this channel, said something that stuck with me. He said this is about creating shareholder value. So let's score it. eBay, starting market cap in 2015, about $33 billion. They spent $25 to $30 billion buying back stock. Revenue grew at 2%. CEO made $20 million a year and sold shares. Market cap today, $43 billion. Net shareholder value created, maybe $10 billion over 11 years. After spending $30 billion, that's like investing $30 to make 10. Your ROI is negative. You destroyed capital. Strategy. Starting market cap in 2020, $1 billion. They raised capital through convertible notes, equity, and STRC. Built a Bitcoin treasury worth $62 billion. created a yield product for retirees. Market cap today, 43 billion. And that's actually discounted to the value of the Bitcoin they hold. Net shareholder value created, 42 billion in market cap, 62 billion in Bitcoin, an income product serving millions of retirees and Gen Xers. From 1 billion to this, in 6 years, one company spent 30 billion to create 10 billion. The other spent zero on buybacks and created 62 billion. That's the difference between financial engineering pointed at yourself and financial engineering pointed at the future. Let me put this side by side. Same market cap, two companies that could not be more different. eBay, 43 billion market cap, 10 billion in revenue growing at 2%, PE ratio 25, shares retired 63%, CEO makes 20 million, owns 0.09%, selling shares, cumulative buybacks 25 to 30 billion, Treasury asset none, income product none, GameStop tried to buy them, strategy 43 billion market cap, minimal software revenue doesn't matter, PE ratio doesn't apply, it's a Bitcoin treasury. Shares issued, yes, to buy Bitcoin. CEO makes $1, owns 9.9%, can't sell. Cumulative buybacks, zero. Treasury asset, 843,000 BTC worth 62 billion. Income product, STRC, 11.5% annual yield, monthly tax deferred. The market wants to buy them. One company shrank itself to stay in place. The other reinvented itself to leap forward. One CEO cashed out, the other went all in. One company has no product for the 65 million retirees who need income. The other built one that pays 11.5% tax deferred. Same market cap. Not even close to the same story. Look, I'm not here to bash eBay. They pioneered e-commerce. They created PayPal. They've been around for 30 years. That matters. But when we talk about what management did with shareholder capital, $30 billion over a decade, the comparison is devastating. They retired 63% of their shares, and the stock tripled. Strategy issued shares to buy Bitcoin and went from 1 billion to 43 billion. One company used financial engineering to shrink, the other used it to grow. And then there's STRC. Strategy didn't just create a treasury, they created a product. 11.5%, monthly, tax deferred, for the millions of retirees and Gen Xers who need income right now. That's product market fit that Wall Street hasn't even begun to price in. eBay gave shareholders buybacks. Strategy gave shareholders a Bitcoin treasury and income for life. $30 billion spent to stay in place versus zero buybacks and 62 billion in created value. Same tools, same market cap, opposite results. That's the second level of Jackassery. Next week, same game, same market cap, another company that chose the treadmill over the rocket ship. I'm lucky. See you then.